Hello. Okay, we are going to talk about the exam. So the exam is coming up that Monday, the 21st, when we come back from spring break. So do not forget to come back from spring break. Have a good time, but make sure you're ready for the exam. So I have a lot of stuff out here that can help you prepare. And out in Blackboard, we have a couple of areas. First is the quiz and exam information area, and the other is the chapter multiple choice answers. So as you study, if you want to use the multiple choice questions at the back of each chapter, practice those questions and you can find your answers right here. The really great thing about these answers is that as you look at them, you'll see that it doesn't just tell you the right answer, it actually tells you why the right answer is the right answer and the wrong answer is the wrong answer. So it really helps you understand how to read these questions, and that's important. All right, the next thing I have out here is the quiz and exam information. It has old quizzes from past classes. So last semester, you can look at last semester's quizzes and their keys. You can look at last semester's exams. You can look at our actual quizzes we took this semester. Also, you can look at our in-class activities. I think looking at our in-class activities will help you a lot because we have those two simulation questions at the end. To find the in-class activities, they're in assignments, in-class activities, and there's the problem and the key. So they're all out there already. So back to quiz and exam information. We are going to be doing exam 2. So out here you have a study guide, and that's just an outline of the chapters, tells you what to focus on, what you don't have to focus on. You have last year's exam. So you can take the exam once you're all done studying. You can take the exam and see how you do. That'll give you a good idea if you've studied enough. And if you miss some questions, you might want to not just check out the key, but check out the explanation of the hardest questions from this exam. All right, so also out here is the PowerPoint. So if you want to follow along as I talk, this is the exam 2 review PowerPoint, and that's what I'm going to be going over with you today. Alright, so let's hit this PowerPoint real quick. First thing is going to be super important to you as the class continues, not just this exam, but understanding those assertions and what they mean to the financial statement. So this is simply that Exhibit 1.5 from Chapter 1, way back at the beginning, when we first went over assertions. And you need to understand that as auditors, we're auditing the financial statements. So I'm going to come in here and audit this company, and I'm going to say, yeah, that number is fairly presented. But for it to be fairly presented, it doesn't just mean that number's that number, right? It means those funds exist, that the organization has the rights to those funds, that it's complete, everything that's supposed to be there is there, that it's presented, as it's supposed to be presented, all those assertions. So if you don't know those yet, go back and review Chapter 1. Go back and review all the chapters where we talked about that. Go back through old quizzes. So make sure you understand this concept of completeness, accuracy, all of that. There's, as you may recall also from Chapter 2, this is not going to go away, there's 2 organizations we're mainly concerned with. PCAOB makes the standards for auditing public companies, and AICPA makes the standards for auditing non-public companies. So they set the assertions up a little bit different, but really it just means the same thing. The financial statements, when you say they're fairly presented, it means they have all these qualities, that for each account that you're looking at, either the assets exist, or let's say you're talking about sales, like in Chapter 7, those sales actually occurred. Rights, if it's an asset, you have the right to it. If it's a liability, you have the obligation. Complete, everything is there. Evaluation, the correct amount. in the proper period. Presentation and disclosure, appropriate place. Management assertions from AICPA have slightly different formulas. PCAOB just says these are the assertions and apply it to a transaction or apply it to an asset or a liability as is appropriate, right? Whereas AICPA splits the assertions up into transaction assertions, balance assertions, and presentation assertions. So transaction can occur, it can be complete. Cutoff means it's in the right period. Accuracy means recorded in the correct amount for a transaction. Classification, it's in the right account. Balances can exist. You can have the rights to an asset or the obligation to a liability. All balances include all items. Accuracy and valuation, numbers are right. Presentation and disclosure, same ideas, but we add in this idea of understandability. So if you aren't really hip to those assertions yet, put a lot of time and effort into that. It will really pay off for the rest of the semester. Audit risk model. As you know, we're doing an audit. At the end of that audit, we're going to give an opinion. The opinion is these financial statements are fairly presented, or maybe they're not. Maybe we say they're fairly presented except this account is misstated, or we disclaim it, whatever, we give an opinion. But there's this risk we could get the audit wrong. I could say these financial statements are fairly presented when the truth is, the management was committing fraud, there's something bad going on, and really, they're misstated, but I didn't catch it. That's what we call audit risk. So the risk of unknowingly giving a bad opinion is a function of inherent risk times control risk times detection risk, right? So when we go on an audit, in order to keep audit risk low, as an auditor, I do several things. The first is I understand inherent risk. So every time we talk about auditing any kind of account, we think about what's the risk to that account. All right, so the risk to cash is people want to steal it. The risk to revenues is management wants to inflate it. The risk to accounts receivable, employees want to steal the money that's coming into them, and management wants to inflate that asset. So there's risks. Therefore, the organization that is being audited, the client should impose some controls. Now, controls aren't perfect. They have risks too. So as an auditor, I need to think about what are the inherent risks, what are the control risks, and in order to figure out the control risks, I have to sort of test those controls, see what's in place, see if they're using them properly, and then I decide, those controls are good or those controls aren't too good. Then once I've discovered inherent risk and control risk, now I understand the risk of material misstatement, right? Because that's what I really want to get at as an auditor. Are those financial statements misstated or are they good? In order to figure out if they're misstated, I need to do some detective stuff, right? I need to do some substantive tests of balances. But I may not get that right? There's some risks to that. I could, if I'm doing some random sampling, I might just randomly pick all the good files when really there's some bad ones that didn't get picked. Or I may do a bad job. I may send the intern to go do that work and the intern doesn't do a very good job. So detection risk exists, and as an auditor, I can make this risk higher or lower by doing a good audit, right? So I want it to keep this risk very, very low. I'll do more thorough or less thorough tests, right? I'll alter the nature, extent, and timing of my substantive tests, depending on if I want detection risk to be low or high. So every audit is going to have this idea that there's inherent risks in the account. The client puts some controls in place, but they're not perfect, so there's control risk. Inherent risk and control risk equal risk of material misstatement, and as an auditor, I need to estimate this, so I can figure out how many substantive tests I need to do to increase or decrease detection risk. So that's how an audit goes. So for every account now, we're going to start talking about what are the inherent risks, what are the controls that should be in place. What's the control risk? What tests can I do? So that's what chapter 6 and 7 are really about, is figuring this stuff out. In order to test controls and do some standard tests, I'm going to do things like inspections and inquiries and confirmations and analytical procedures. And one thing I'm going to do is inspect documents. Now, when I inspect documents, I'm doing two different things, all right? I may be picking, there's actually three things I can do. I can get a set of documents like a set of invoices or a set of bills of lading. I just can go pull random samples of purchase orders or pull random samples of customer orders, whatever. I'm getting some samples. I'm going to do some audit detection work. What do I do with those documents? Well, I can scan them, which means I kind of look through them and see if anything looks odd. Maybe I look to see, are they in order, right? If they have a numerical sequence, I could scan them and pretty quickly figure out if anything's missing, right? If I'm scanning a list of all the debits and credits, it'd be pretty easy if I'm going through the sales account and I'm looking at all the lists of all the transactions. If I see a debit, that would be weird, right? So, maybe I'm just scanning, looking for something. But sometimes I grab a set of documents. I'm doing these specific procedures called vouching or tracing, right? So vouching is where I'm testing for occurrence or overstatement. And that means that the books, the ledgers, the sales journal, the actual account, the actual transactions that make up the account balance, if they're overstated, that means they didn't occur, right? Or they didn't pertain to the business, right? You could have an employee doing something bad and something occurred but it didn't really pertain to that business. It was their personal thing that they were stealing. So, depending on where I start as I do my selection of documents and which direction I go, that tells me I'm vouching or tracing. All right, so I vouch for overstatement and I trace for understatement. Okay, so what that means is, overstatement is, I'm trying to see, did all those sales, let's say we're doing sales because chapter 7 is sales, and that's this idea we talk about chapter 7. So one thing people want to do is inflate sales. So that means they could be overstated, or there can be sales on the books that didn't really occur. Okay, so we're testing for occurrence. So I'm going to vouch, VOO, vouch for occurrence or overstatement. So I'm going to pull a sample from the sales journal, right? The listing of all the sales that occurred and their transaction amounts. So I pull that list and I vouch back to the source document. Because if it's a real sale, if it actually occurred, well, there's going to be a bill of lading, there's going to be an invoice, there's going to be a customer order. There's going to be source documents I can go to that prove, yes, that really occurred. So vouching for overstatement or occurrence means you start with the listing, like say sales, and you go back to the source document. The other thing you can do with documents is trace. So tracing means you're testing for completeness or understatement. So if I think that there's something bad in the controls that don't let everything get into the listing, like say I think some of the sales didn't make it to the listing, so they're understated. Look at the ledger account balance, it's understated. Well, obviously, if I think it's understated, they're not there, right? I can't start there like I did for occurrence, so I have to start down at the source documents and trace them forward to make sure they got in the listing. So I would pull a sample of bills of lading or invoices or something and trace and make sure they got into the journal and therefore the ledger. So vouching versus tracing, important concept to understand. Vouching for occurrence or overstatement, tracing for completeness or understatement. Chapter 6, real basic, understand these components of the fraud triangle. Motive is why you do it. You have some kind of pressure. You got a divorce, you're using drugs or gambling. You have some kind of pressure to steal. Rationalization, well, it's okay. That's where honest people tell themselves it's okay to steal. They say, well, I'm just borrowing it. I'll pay it back. or they didn't pay me my bonus this year, so they really owe me this, or something like that. Rationalization. Opportunity is, well, that some of the controls aren't working very well. So they see they can steal this and nobody's going to catch them. So motivation, rationalization, opportunity, make the fraud triangle. You should be able to recognize examples and match them up. So, for cash, chapter 6 is testing cash. So when you look at a balance sheet, top left, cash, is that number really that number? That's what we're auditing for. So what are the risks to cash? Well, basically the risks to cash are people want to steal it, right? So then they'll cover it up. So we have to have controls in place that prevent people from stealing, right? And so these controls have to control for all our assertions, right? So make sure you understand what controls should be there. Well, you don't just have checks sitting around. They're not printed until voucher packets are prepared. Only authorized signers. Checks are pre-numbered. Here's a little hint. Whenever you see pre-numbered, that's going towards completeness. Right? Cut off. Anytime you see something checking for what period something's in, anytime you see checking at the end of the month, timeliness, that's always about cut off and is it in the right period. So, there's inherent risk with cash. People are wanting to steal it. There's controls in place that control for all the assertions. You as an auditor then may want to test the controls, right? So there's going to be things you can do. So if checks are supposed to be printed when a voucher packet's prepared, you can check and make sure that those vouchers exist, that people are checking them and doing the things they're supposed to do. If checks are supposed to be pre-numbered and accounted for to control for completeness, you can check that sequence, right? Pull out the checks, make sure they're in order. So you can test to make sure those controls are being done. Once you've tested the controls, you're going to have some idea, like, oh, they're good, oh, they're bad. Then you'll go ahead and here's some more controls. You can just memorize that stuff. You can go ahead and do substantive procedure. In other words, you're testing the balance. All right? So for cash, the main test is to check the bank balance and compare it to the ledger balance, and you do a reconciliation. You may want to get a cut-off bank statement. Do that so that you know that you're using real documents, not something the company has made up. But first come inherent risks, second come control tests, third come substantive tests. Same thing for Chapter 7. Inherent risks we've talked about. For Chapter 7, inherent risk to revenue is that people are wanting to inflate revenue either by, not telling auditors about return policies, putting things in the wrong period, recognizing revenue when really it's unearned revenue and a liability. So if anything that inflates revenue, you got to watch for. Anything that inflates accounts receivable, you got to watch for. And so there's, of course, going to be controls that relate to the assertions. Nothing new here. So understand from the book those controls. Go to the book and look at what accounts are involved, what controls there should be. And then, as auditors, we test for controls. So you should make sure you're understanding assertions, controls, and tests. Once we've decided how the controls are, right? I understand inherent risk. They want to inflate revenue, inflate receivables. There should be controls in place. I've tested for the controls. Now I'm going to check the balances. Right? So substantive procedures are things that confirm the account balance that tells you that number on the balance sheet is the correct number. All right, so you might do confirmations, which you're sending out to the customers, the accounts receivable. You might vouch for occurrence. You might inquire from the bank if they really have that. There's tests you can do. So we've talked about those in class. You can go to your book and study those. You need to make sure you understand the difference between control tests and substandard procedures. Next, we're coming up to Module B. The main thing, the only thing I care about for Module B is independence and what auditors have to do to be independent. So an auditor has to be unbiased, right? They're offering their unbiased opinion about those financial statements. If they're biased, they might not tell the truth. People won't trust them. There's threats to independence. Even though an auditor may think of themselves as unbiased, if there's any of these threats in place, they're not independent, right? Too close a relationship, familiarity threat, adverse interest, acting in opposition, maybe the client suing you, you're suing the client. Undue influence, coercion, bribe, threats. Self-review, CPAs reviewing their own work. Frequently, you might consult with a company. You can't then turn around and audit stuff that you told them what to do. Financial self-interest. This is easy to understand if you own stock or you own part of that company or you have a financial relationship with that client. You're not going to do things that would hurt your own self-interest. You can't be a manager, which doesn't mean you actually work for the company, but performing management type functions. Advocacy threat, promoting their interests. So you have these threats to independence. You can look in the book to help understand them. It's important that you understand when you are, and examples of when you are not independent. So just in the book, in Module B, just go with threats to independence. All right. There's a lot of other ethical stuff in there, but I'm only going to ask you questions about auditor independence. Auditors can be sued. That's Module C. So make sure you understand not these cases like Ultramar's, Credit Alliance, Gloucester, Adler. You don't need to understand that. What I want you to understand is basically from this table that's in your book or right here, I want you to understand these terms, right? What's the difference between common law and statutory law, right? What's the difference between breach of contract with a client and a tort for a third party? What third parties are there? Well, there are foreseen and foreseeable. What's the difference between ordinary negligence, gross negligence, and fraud? All right. What's the difference between Securities Act of 33, that's the IPO Act, and 34, that's the Securities Exchange Act after stock has been trading. So I wouldn't expect you to be able to take a case and say, this case, the auditor's liable, this case is not. Just definitions and understanding of these terms. What is good faith? What is due diligence? That kind of thing, so the terms. And that's all I really expect you to know for the exam. So study that study guide, practice those multiple choice questions, shoot me email. Even though it's spring break, I'll certainly be checking my email and my text. So if you do have a question that's not covered in the study material, give me a shout. And have a great spring break, but be careful. Come back.